Well, some insurance policies contain either a specific exclusion for flood or provide only limited coverage for a particular type of flood event defined in the policy. Some insurance companies have played hardball, but it's important for householders to understand, though, that from a legal perspective, they may still have some prospect of progressing their claim if their insurance company did not properly advise them that their policy contained a flood exclusion. It really comes down to consumer rights. The Commonwealth Insurance Contract Act applies to contracts of general insurance, including the home and contents type policies on which people will usually claim for flood. The Act operates with the stated purpose of striking a fair balance between the interests of insurers and those who are insured to make sure that the policies and practices of insurance companies operate fairly. Helpfully for Brisbane flood victims, the Act provides for a default level of cover in respect of home and contents policies, which will include indemnity for damage caused by flooding. While insurance companies are still permitted to specifically exclude cover for flood in certain circumstances, the Act imposes significant notification obligations on the insurance company in that case, and places the onus squarely on the insurance company to prove that those obligations have been complied with in order to uphold the exclusion. Let's talk first about standard cover insurance contracts. The Commonwealth Insurance Contracts regulations provide that where the insured is a natural person, that is, not a company or a corporate entity, a policy of insurance in respect of destruction of or damage to a home building will be deemed to be a prescribed standard cover contract for the purposes of the Act. Importantly, the regulations also provide that damage or destruction to a home building caused by or resulting from storm, tempest, flood, the action of the sea, high water, tsunami, erosion or landslide or subsidence is a prescribed event for the purposes of such standard cover contracts. Now, the amount of cover provided in that circumstance will include the total cost, to a maximum of $2 million, of repairing the damage to the home, as well as the reasonable cost of demolition and removal of debris and emergency accommodation. Where a contents policy was in place, indemnity is also to be provided for the household contents items. Now, let's examine flood exclusion clauses more closely. As I mentioned, insurance companies are entitled to exclude standard cover, provided certain conditions are met. In order to displace the standard cover deeming provisions and avoid liability for a claim resulting from flood, the Act requires that the insurance company must prove 1. That the insurance policy expressly excluded cover for such an event, and 2. That before the insurance contract was entered into, the insurance company clearly informed the insured in writing that the policy would not provide cover for the event. It will often be sufficient for the insurance company to show that the exclusion was clearly set out within the policy wording or product disclosure statement, the PDS. That is, the insurance company are not necessarily obligated to provide a separate or plain English explanation. However, the important point remains that if there is any confusion about exclusions or the timing and provision of the necessary documents, these circumstances are matters which ought to be further investigated by an insured. The very nature of flood damage will often mean that some of us have lost access to their records and documents, and in those circumstances it may be an important step to put the insurance company to proof, to ensure it can effectively establish why flood cover should not have been extended. It is certainly not difficult to imagine circumstances in which an insurance company may not have complied with its notification obligations. For example, due to basic oversight or a breakdown in process, the insurance company may have simply failed to deliver the required policy documentation. Further difficulties for insurance companies may arise by virtue of the fact that insurance is sometimes arranged and paid for by telephone. If a customer applied for cover in this way, and immediately accepted and paid for the cover without having been provided with a copy of the policy or other documentation, the customer may well argue that standard cover applies and that they are entitled to recover for any subsequent flood damage. Well, what about policy renewals? Well, in addition to investigating the circumstances surrounding the formation of the initial insurance contract, it may also be necessary to investigate the circumstances of any subsequent renewals. When a policy is renewed, the legal position is that a new insurance contract is entered into on each renewal. In circumstances where the insurance company has changed the policy terms, for example by introducing a new exclusion or restriction in respect of flood, they are obligated to provide the customer with a copy of the new wording or PDS. This presents another opportunity for oversight by insurance companies, and consumers could again give consideration to ensuring that the insurance company can prove that the proper documentation was in fact delivered prior to the renewal taking effect. Let's now make some brief comments about the method of inundation. Well, the way in which a property is inundated may also affect the coverage afforded by the policy. At present, many insurance companies define the term flood differently to one another. Commonly, if damage to a property has been caused by rainwater runoff, for example from a road, that event will not usually fall within the definition of flood, and accordingly any flood exclusion would not apply. It is also worth considering that in some circumstances there may be concurrent causes of water inundation. For example, excess rainwater may have run off a road and flooded a house, while at the same time a waterway has risen and also contributed to the inundation. It may be that one event would be covered, for example rainwater runoff, and the other excluded, for example waterway flooding. And in that case it may be difficult for an insurance company to enforce the flood exclusion where it is unable to effectively prove which event has caused particular damage. A further example is that some policies may define flood as including the escape of water from a dam. Now, it's debatable whether this definition would include the intentional release of water from a dam by government authorities, thus introducing another point of contention in relation to claims arising from the recent flooding of Brisbane. Again, if an insurance company seeks to enforce a flood exclusion in such a circumstance, the onus is on it to establish the basis for damage not being covered by the policy. Having said all of this, let's now talk about some suggested strategies you might want to take. First, if you have been declined indemnity for flood damage to your home, I recommend that first, number one, you carefully review your policy wording and seek legal advice if necessary. 2. Investigate the circumstances in which you entered into the policy to establish whether you were properly informed in writing of the relevant exclusions before entering into the contract. 3. Consider putting the insurance company to proof that it is entitled to rely on the flood exclusion and that standard cover ought not apply. And 4th, if cover was arranged through an insurance broker, investigate whether the broker has provided proper advice in relation to flood cover and obtained insurance in accordance with their instructions. Additionally, you should note that if you are not satisfied with the insurance company's initial response to your claim, you are entitled to seek an internal review of the decision by the insurance company's dispute resolution department. If that process fails, you may then take your claim to the Financial Ombudsman Service for an external review of the insurance company's decision.